Companies looking to expand their reach and capital often consider going public. But what does this process actually entail? And how do businesses qualify for this significant transition? Going public refers to when a private company offers shares to the public through an initial public offering or other methods. This transition transforms a privately held business into one owned by public shareholders, bringing both opportunities and responsibilities. The most compelling reason companies choose to go public is access to capital. By selling shares on public exchanges, businesses can raise substantial funds for expansion, research, debt reduction, or acquisitions. This influx of money can fuel growth in ways that might be impossible through private funding alone. Stock liquidity represents another major benefit. Public companies can use their stock as currency to acquire other businesses or to compensate employees through stock options. This creates a valuable tool for both corporate strategy and talent acquisition. Public companies also enjoy increased visibility and brand recognition. The publicity surrounding an IPO and subsequent trading can significantly raise a company's profile, potentially attracting new customers, partners, and opportunities. For early investors and founders, going public provides a clear exit strategy. Venture capitalists and angel investors can realize returns on their investments, while founders can diversify their personal wealth beyond the company they built. The process of going public involves substantial preparation and commitment. Companies must be ready to sacrifice some operational flexibility in exchange for public capital. Management decisions become accountable to shareholders, and the freedom to make quick, unilateral changes diminishes. Regulatory compliance forms a major part of public company operations. Organizations must register with the Securities and Exchange Commission and adhere to the Securities Exchange Act. This includes regular financial disclosures, reporting of material events, and transparency in executive activities. The time commitment should not be underestimated. Senior leadership will spend significant hours preparing for the public offering, meeting with potential investors, and building relationships with financial institutions. This diverts attention from day-to-day operations during a critical transition period. To qualify for going public, companies must meet specific SEC registration requirements. This includes filing a registration statement, typically Form S-1, containing audited financial statements, management analysis of financial conditions, business operation details, risk factors, and information about the securities being offered. Financial and operational metrics vary by exchange. The NASDAQ capital market requires at least $5 million in shareholders' equity, a minimum of 1 million shares in public float, with a market value of at least $15 million, and at least 300 round-lot shareholders. The New York Stock Exchange has even higher standards, requiring pre-tax earnings of at least $10 million over 3 years, global market capitalization of at least $200 million, and a minimum of 400 U.S. round-lot shareholders. Corporate governance standards also apply to public companies. These include maintaining an independent board of directors, establishing an audit committee with independent members, holding regular shareholder meetings, and ensuring transparency in executive compensation and insider transactions. Ongoing legal and reporting obligations continue after going public. Companies must file quarterly and annual reports, make timely disclosures of material events, report insider trading activities, and comply with Sarbanes-Oxley requirements for financial controls and audit oversight. Companies can go public through several methods. The traditional initial public offering remains the most well-known approach. In this process, large brokerage firms underwrite the offering and often guarantee capitalization. However, this option is typically available only to companies that meet stringent requirements. Reverse mergers offer a more accessible path. A private company merges with an already trading company that may have failed as a business but maintains its public listing. While less expensive than an IPO, costing between $200,000 and $300,000, this approach carries higher risks. Merging with a virgin shell has grown in popularity. These special-purpose entities are specifically designed for merging with operational companies. The cost ranges from $65,000 to $400,000 depending on whether the shell has already received SEC approval. The long way involves a private company issuing an offering followed by stock registration and filing to trade. This method typically takes about a year but costs less than other approaches. usually between $50,000 and $100,000. Newer alternative methods have emerged in recent years. Direct listings allow companies to list shares on an exchange without raising new capital or using underwriters. This approach works well for businesses with strong brand recognition and sufficient cash reserves, like Spotify and Coinbase. SPAC mergers have gained prominence as another alternative. A special-purpose acquisition company is already listed on an exchange with the sole purpose of acquiring a private company. This method offers a faster timeline to market, pre-negotiated valuation, and potentially more favorable deal terms. Foreign listings and American depository receipts provide options for U.S. companies to list abroad or for foreign firms to access U.S. markets. These approaches involve compliance with multiple regulatory frameworks. Small businesses can indeed go public, but they must demonstrate growth potential, regulatory readiness, and financial viability to attract investors and meet exchange standards. While profitability is not strictly required, companies need to show strong growth potential and a compelling business model. The timeline for going public varies by method. Traditional IPOs generally take 6 to 12 months, while alternatives like SPAC mergers or direct listings may move more quickly. Each approach offers different balances of cost, time, control, and risk. Going public represents a transformative step in a company's life cycle. The increased capital, visibility, and strategic options must be weighed against the regulatory burden, loss of privacy, and pressure for short-term results. For businesses that qualify and prepare adequately, public markets can provide the resources needed to reach new heights of growth and success.